Good afternoon. This is Tom Aspray with the Viper Report. It's Tuesday, February 15th, just before the close of trading, and it's been a real good day for a change. There's been huge swings up and down for the last month or so, and today's one of those swings up. Let's look at what we're doing in the stock market as we head into the close. You can see pretty good performance, up 408 for the Dow, 2.4% for the Nasdaq. S&P is up 65, 1.5%. Market internals are good. This is one of the pages I follow on a daily basis and have for decades. And of course, you can always email me at tom@viperreport. If you don't have this link, it's the Wall Street Journal /market-data/stocks. It's free. 2,523 advancing. I track these during the day, so this has gotten a little weaker. Earlier in the day, there were only 660 declines. 846 now, so still 3-1. That's great. Very strong in the Nasdaq too. Unfortunately, the new high is only 33, new lows 178, and the Nasdaq high-low data is even worse. I have talked frequently the past couple months about the high-low analysis. This is a tweet that I put out on January 2nd, and was casting a pretty negative message for the market. You can see here we have the Nasdaq Composite, a daily chart. So the new highs peaked as prices were making their high in early November. And then as we made another new high at this 0.1, you can see there were much fewer number of new highs. So that was a sign the market was going higher. The prices were higher in the averages, but fewer stocks were pushing the market higher. That's a sign of weakness. And, for a trigger, we look at the action of the new lows. They'd been in a range here, throughout the fall, but they spiked at this 0.3, signaling that the sellers were taking over. And, even though we had a couple of nice rallies up, it's they're still in charge. Even though this chart was as of a month and a half ago, that hasn't changed. I would encourage you to follow me on Twitter. I do update my analysis generally daily and sometimes more than that each market day. If you're interested in more about the high-low analysis, that front page article in the Viper Report, Consistent Warnings Before the Market Declines, takes you through a bunch of examples. Okay, so this is a follow-up. That chart I just showed you was as around here. You can see what happened to the Nasdaq 100. Number of new highs continue to be flat. They're about 160 here, this line E. If we get above that, that would be a good sign. We haven't got close yet. And the number of new lows continues to expand as the market has dropped. That's not a good sign. In the article, I look at examples, back into, this one is in 2020. You can see the new highs peaked in February before the stocks collapsed in reaction to COVID. And once again, the number of new lows surged here at this line E, telling you that there's trouble laid ahead. You can follow this back historically at most big market corrections. You'll see this high-low analysis. This is 2018. Market was moving higher. New highs were starting to deteriorate. And then in early October, we got a surge in new lows here. And the number of new highs were dropping sharply. And that lasted for 3 months, basically. I will note that the high-low analysis is better for warning you of a market top than it is of helping you identify a market bottom. That's just the way things work. Occasionally it'll be really good, but not always. For example, in 2019, the new highs didn't surge until early February, and at that point the AD line was also making a new high. So you had double confirmation at that point. Well, let's take a look at the current market condition. You can see this is SPY, equivalents of the Stark bands in greens. We got very oversold here in the end of January. There were no real divergences in the S&P AD line. It did form lower highs, but as did prices, and then things started to get pretty ugly, around the 12th of January. You can see the stocks only AD line was acting even weaker. S&P made a new high here, and the Nasdaq 100 also made a new high in December, but the NYSE AD lines didn't. Showing a severe weakness. below their moving averages. They just popped above them last week. We had a nice rally off these lows, but they turned lower again. This is the only one that's updated as of Tuesday, February 15th. The AD line has turned up, but first of all, you got to get above these peaks and then above this downtrend line D, line C, and line B to really indicate that the correction is over. Of course, if you want to read all my articles on Forbes, you can just Google Forbes : Tom Aspray. You get this list. This was the start of the month. I published an article. Does the technical view point to a change in the major trend? A lot of people are asking me. I thought this was the new bear market. I do not. I think this is, a correction in a bull market at this point. That could change in the next couple months, but I think that this correction is going to lead to a very good buying opportunity. Right now, the short-term trend, as you showed by the AD stuff, is still negative. You can see from this weekly chart that was from Monday's Viper Hot Stocks, the Nasdaq 100 AD line, the weekly is below its moving average. So until that turns around, the trend is down. Why I think it's not a bear market, the same analysis I used in 2018. I got lots and lots of emails from people who said, thank you for helping me stay in stock during that period. Of course, market turned around in early 2019, has made a series of new highs since then. But, the Nasdaq now it could drop down to this support level. So, there's no signs yet that from either the daily or the weekly analysis that things are turning around. That does not mean there haven't been opportunities. For the open on January 24th, which was a really ugly day, I wasn't making many buy recommendations, but Devon Energy has treated us really well this year, and this is what the chart looked like as of that Friday's close. And I thought, well, okay, I think we're close to a reverse to the upside because things were very oversold. So I put out this buy levels here for Devon Energy that, meant that it was going to go from 46 down to, the 43, or lower area. You can see the relative performance was still positive. The OBV had dropped back below its moving average, but the weekly was still strong. You can see what happened. We got down to 42.87 on January 24th and reversed sharply to the upside. This chart is as of the 26th, just a few days later, and we are already trading back at new highs above 51. You can see the OBV reversed, and the RS stayed positive throughout that. This chart kind of brings you up to date. We sold out part of the position at around 53.80 something for over a 22% profit. Then last week, you can see we saw some problems with the OBV. It started to turn lower. It was diverging from prices. That suggested we're going to see more of a correction. So we sold the other half. Trust me, not all of our trades turn out quite that great to take 22% in 4 or 5 days, but occasionally they do. We have not seen too many ETFs that we like. This is one we started liking at the start of February. This is the Invesco Pure Value, the RPV. Looked quite good. We'd gotten up above the Stark band here at the start of the year, pulled back into the monthly pivot, the 20-week EMA. Volume was strong, and it had a strong weekly close the week ending January 28th. The relative performance had broken out above this resistance line C and also at line D. So this is both of our buy levels were hit here, and that's one we like. The analysis of growth versus value is still favoring value. This is what last week's chart looked on the. This is the growth versus value ratio. When it's rising, growth is outperforming value. When it's falling, like it has since November, pretty much, value is outperforming. You can see it's broken down here. If it breaks below this support at line B, it will suggest a major change in that trend, which does look likely. This is a good chart. If you look at the Forbes article, this last weekend one, are really a classic interpretation of how you can use the MACD histogram no matter what market you're trading. So, formed a negative divergence here before the peak in the fall of 2021, formed a nice bottom here in June, actually this is in the fall of 2020, in the spring of 2021, growth bottomed out. We had that nice rally, but as the growth was peaking out here, MACD HIST was diverging from prices. So, if you want some tips on timing the market and understanding technical analysis, if it's something that interests you, we can help you with that. So in conclusion, I expect the volatility to remain high. I don't think the worst of the Russian threat is over. Plus the rate hike debate would take me, half an hour just to explain how stupid I think that is at this point. When it happens, it'll happen. But if you'd like to see some specific information on where stocks are headed and which ETFs or stocks you should consider buying with, strict risk control, I hope you consider either the Viper ETF report or the Viper Hot Stocks report. You can sign up on the viperreport.com. And of course, if you're interested in any training, we are actively doing training courses and have a lot of new satisfied clients. Keep your seatbelt fastened, and I'll stay in touch.